Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Factset Research Systems stock, ticker FDS. That was a lot harder to say than you would think. As always, this is not individual investing advice. This is just how I analyze stocks. This one came in by request down in the comments section of one of my other videos. If you have a request for a stock analysis you would like me to do on the channel, just put it down in the comments. I will put the ticker on the whiteboard behind me, and eventually I'll make a video for you. If it's a stock that's in the S&P 500 like Factset, I post those on YouTube for free. The rest I post over on Patreon at the $5 tier per month level. I also have a $25 a month tier level on Patreon where I share a stock pick each week, just the best stock that I can find for a medium and long-term investment opportunity that particular week. I started that at the beginning of October, and it's doing really well. People like it, and it's I think it's double the S&P 500 returns right now, so I'm happy with that. If you're interested in that, head on over to Patreon. I'll have those links down in the description. There's a free tier on Patreon too, where I post all the same stuff that I post here on YouTube, and you can watch there for free. You don't have to rely on the YouTube algorithm to find me. And let's see, is there anything else? Oh yeah, I have a 25% off affiliate link for FastGraphs, which you'll see me using here for this analysis. And this is going to be a pretty straightforward analysis, which is kind of nice to have every now and then, just so you can see like what a really kind of basic analysis should look like and what an easier one can look like, and it makes kind of the math and everything easier too. So Factset provides like data and stuff. I know they do like market data. I don't think they're like an actual exchange. I think it's mostly just data. I was gonna say FastGraphs data used to come, I think, from Factset, but now it comes from S&P Global. So the first thing we like to check here is the historical earnings pattern. And this one is really pretty much just secular growth. That means it grows every single year without going down. I want to say from memory there might have been a year where they just barely, like they grew. Oh, no, they grew every single year. Looks like. Okay, so can't beat that. Every year your business is growing, and the stock price has also pretty much grown. It's been a good compounder over the years. Almost 15% CAGR over the past 20 years, so that's just fantastic. This is definitely a high enough quality stock that I would like to own it. So the question now just comes, how much is a good price to pay for it? Because, you know, there's a big difference. So this is nearly a 30 PE right now. I don't know if there's a time in the past where, oh, there we go. Yeah, so let's say that's a similar time where the PE was similar. And let's click that point and go to here and see what the returns are. 12.43% CAGR. Now let's say we bought it, that's like the very bottom of the decline of the March 2020, but let's just pick like 2008, like a PE, or maybe we'll go a little higher. Let's do like half the PE. So it falls like 50% or whatever. And then we'll see the returns. That's almost the same time period. It's only like a next year or something. So there you get an 18%, almost an 18% CAGR. So a 1,200% return. I didn't look and see what the other, sometimes it's good to look at that too. We'll do that again. 1,200% return if you buy lower compared to a 550% return if you decided to pay one of the higher multiples. So you could still do well, but I mean, it's just a matter of, this is obvious or whatever, but sometimes it's important to point out. If you pay a higher multiple, even if the business does well, you're going to not make as much money as if you were able to pay a lower multiple. And we see just recently that you get those opportunities for at least a somewhat lower multiple, right? So if you bought during the last peak at the end of at the beginning of 2022, you are currently down a little bit, and we've also had like 11% inflation since then. So you're still underwater. Whereas if you bought during this dip, just a little later that year, like 6 months later, then you would be up 35%, and you'd have that kind of longer term 14 to 15% CAGR. So that's the difference between paying like a fairly high multiple still and paying an exorbitant one, which is what 40 was. That was the highest it's pretty much ever been. Now, The business performed exactly the same. It's just what you're paying for those earnings. So that's why we do the valuation. I just thought I'd cover that really quickly here. So let's get into this. So I shortened this time period just so we get the more recent data. We had a couple. These are all pretty fast growth years, honestly, and only COVID was a bit slower, and we had a big boost, and then so they kind of have a fast year, slow year, fast year, like slower year. Analysts are thinking, we'll call it high single digit growth over the next couple years. Maybe I'll do this back. Usually I go 2016. Yeah. So that gives us about a 12% earnings growth rate during this time period. If we shorten this to here, about the same. So pretty consistent earnings overall when it comes to earnings growth. So let's do a calculation and see what would be a price to pay for this stock with a margin of safety. So we're going to go to my spreadsheet. So we know it's not cyclical usually. We know that earnings are very stable and growing. It looks like analysts are expecting that earnings growth to slow a little bit, but it hasn't. That's just what they expect. They could outperform or underperform. I'm going to use kind of an in-between growth rate. So FastGraphs had 14%. I control for share buybacks. I didn't look up to see what they were this time, but that's probably why my growth rate's a little bit lower than FastGraph. But this is also a little bit higher than what analysts are expecting. So I think that's a fair earnings growth assumption, like 10.42% seems pretty fair to me. If you look at the 3-year cumulative revenue growth, it actually, so this is revenue, but this is earnings growth. This is a long-term earnings growth rate. This is only 3 years cumulative. But if you think 10% each year of earnings growth, that's giving you almost the same as what the revenue growth was. So that makes me think, okay, my earnings growth rate seems pretty fair over the past few years. Pretty similar because revenues are growing the same way. And this is not revenue per share, really. This is just revenue. So the share buybacks and things don't really affect this number. But short-term changes in business and stuff can. But this is just another kind of quick check I like to do just to make sure fewer funny businesses going on. This can also show you if a business is getting closer to slowing down, maybe declining and getting it. So when this turns negative and we're not in a recession or something, usually I sell a stock. It's almost always a sign. A lot of times what they'll do is they'll go buy something to try to get more growth, and that doesn't work out. So that's one of the first signs. And 3 years seems to be a pretty good sweet spot where if they have a bad year, or something weird happens, they have a couple more years to make up for it. It's not going to be super sensitive to having a bad year or something like that. What we really were looking for is like a long-term trend beginning to develop that is negative. Or we can just look and see if it matches earnings, which it basically does. So again, very straightforward. I make a very small debt adjustment. So instead of treating the stock as trading it to 480, about where it's at now, I treat it as trading at 520. That's due to the difference between the market cap and the total enterprise value. I just look how much higher is total enterprise value. And if it's like, well, I didn't update this for the changes, but I have it as 9% higher. So when I last updated this. And it's not like doesn't need to be like a super precise adjustment. And when the stock price changes, it will usually change this a little bit. So it just sometimes companies have a lot of debt, and that explains why they're cheap. So that's the reason I do it. All right, so moving on, we see the 28 roughly PE ratio. Once we adjust that price up a little bit, we get an earnings yield, which is the earnings over the price instead of the price over the earnings. So it's the same as a PE ratio, it's just expressed differently. So it's expressed as, here's a decimal, but think of it as 3.82%. So if you own this business and you wanted to take the earnings each year and keep them for yourself, which is how I think about this, if you paid $100, you would get 3.28% of that in earnings each year. So you could take $3.28 for every $100, that you pay for the company each year, and that's how much money you would make. So there's a lot of things you can do with it. You can figure out how long it takes you to earn your money back, which is actually 14 years. I don't talk about this very much, but it's a great metric that that I use. A lot of these are just expressing the same thing in a different way. So to earn, like if you paid $100 for it, it would take you $14 to earn $100 and earn 14 years to make back $100 on your $100. That's what this number is. I call it time until payback. That's a good thing to learn, to think about, because sometimes businesses are growing really fast or they're growing at a certain rate, and you think, okay, how long is it going to take me to earn my money back, and what's the possibility something bad could happen in that time? Because sometimes these are like 20, 25, 30 years, and you think, man, it's going to take me 30 years to earn my money back. Well, that can reframe sometimes the way you think about things. So just something to think about there. All right, this is not a super crazy number. Usually under 10 is when it starts getting interesting, if you can get your money back in under 10 years. Okay, so on to the calculations. So there's our $3.28. We're going to grow that at 10.42% each year. And so if you start with 100 after 1 year, I pull the first year's growth forward, so you earn $3.62, and I say, okay, you keep that and you keep accumulating this over time, then how much money could you collect on your $100 over 10 years? And the answer is 100. Well, you would collect an extra $58.90. So 100 goes to 158.90. Put that in a CAGR calculator, and it comes out to 4.74% 10-year earnings CAGR. So that's a little more than a 10-year treasury. It's not very much. And so but the difference is with this, assuming this looks like a quality company, they can probably, at least historically, they've been able to pass inflation on and earn that money back in earnings, whereas a 10-year treasury bond will not be able to do that. So if you think you're going to have inflation, then if we do have higher than normal inflation that we had since 2016, then this number could naturally be higher, whereas the 10-year bond will be fixed. But you can so that's the difference between the two. Along with that, though, comes the risk that the business might not behave historically as it has. Maybe it doesn't grow as fast. Maybe something bad happens and it goes horribly wrong. We've seen that with quite a few stocks lately. I don't think it's probably going to happen with this one unless there's like a big market crash or something like that. But the main thing is, like, you're not really making much more in theory than cash. So all the things, if things are similar as they've been the past 10 years. And so it's not very attractive to me at this price. Now, if I owned it and I owned this for a long time, maybe I would sell half and hold half because it's a good business or something like that. Or maybe sell if I had some losers that I could offset and, not pay taxes on it or something like that. So lightening up when it's at this kind of valuation would be, I think it's a decent idea. It's not close to being a buy. Now, this would be a buy when this CAGR is over 8% for me. That's with a margin of safety. In order to do that, basically, the stock needs to fall about 50%. So down to about 243. So it needs to fall about half. I have a recession metric here. I'm not going to go over it. It's almost exactly the same. So about 50% lower. So they're both pointing to the same. And the reason that those are the same is because probably their stock and earnings is sold off a little bit during it's based on the Great Recession, I think. Usually I write in my notes what I used. I have a link to an article I wrote about it instead. But because their earnings didn't fluctuate too much, they probably didn't fall too crazy much, or not more than 50% probably. Yeah, they fell about 50% during the Great Recession. Let's see what they did recently. So these are kind of good to peek at too, because this wasn't, this was like a flash crash basically. So fell about 30% in March 2020, and then off this recent overvaluated peak in 2022, fell about 30% there too. So if it's down about 30%, it's probably right about fair value actually, but not much of a margin of safety there. But if you decided you really liked the stock, when it gets down about 30% from here, 25, 30%, like halfway there, that would be a decent spot to add if you're not trying to have a margin of safety or or anything like that. So that's something to think about if you think that I'm always just kind of I don't know. I'm trying to get deals. I like to make I like to make more than average money. So and sometimes things go wrong. So you lose less money if you buy them when they're cheaper too. So that's just me. But one of the reasons I have this weekly stock pick thing is because people tell me my buy price are crazy low and they'll never happen. So I created that for everybody who thinks that I never say to buy anything, and because I'm always looking for a big discount, but I make myself find one each week. So if I can't find something that's super cheap, I find something that is good enough. Like there's some other attribute that makes it worth checking out. All right, if you found this video useful, hit the subscribe and like button. Consider going over to Patreon and join the free tier there. It's a good way to just easily get my research and ask me questions. I answer usually every comment as long as it's not something really dumb. And I'll see everybody later. Bye.